Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger Associates Financial Planning. I'm here today with Kyle Ryan, also a certified financial planner as well as a chartered financial consultant. One of my staff, he's one of the associates in the Menninger Associates team, right?
Go figure.
Yeah, imagine that. So anyway, again, we're always trying to produce episodes that are educational in nature. And we try to cover the 6 areas of financial planning, which are cash management, tax planning, risk management, investment planning, retirement planning, and estate planning. And the topic that we're going to be dealing with today, which is almost certainly going to spill into a second and possibly a third episode, is a discussion of Social Security, which is part of retirement planning. Social Security is, on the surface, a simple concept, but man, there are so many nuances associated with it that you can maximize strategies, understanding how it works, when it works, why it works, and how you can leverage it to your advantage.
The different types of benefits, it really gets into the weeds, yeah.
Exactly. So now, I started these shows 3 years ago, and this was one of the first ones I did. I haven't done it since.
It's good to catch up on it.
It is. And so Social Security really hasn't changed in 3 years. However, I think things have become a little clearer about the fact that it's supposedly going to run broke in 2033, 2034.
The longevity has come into question.
That's correct.
Yeah.
The longevity has come into question. It's become more in question since 3 years ago as part of the overall federal budget.
Yes.
And so there's a whole lot of different things. Plus, we're going to do is sprinkle in, the other thing I did is when I did it 3 years ago, I flew solo on it. And today, with you, it gives us the ability to have dialogue, as well as kind of try to illustrate some of the points by using some case studies that we've both had.
Absolutely.
Because that's oftentimes the best way to learn and understand something is to use an example. We use case studies of clients that we've done work with.
Yeah, and it's amazing how often a situation can be similar, but a very, very minor detail can be a little bit different that throws everything out of proportion. It's one of the most unique things to plan for, Social Security.
It is.
When you're speaking one-on-one, because the rules are the same to everyone, but everyone's situations, while they can seem the same, are so uniquely different, it impacts how the benefit they get.
Absolutely. Absolutely. So we'll be touching on a bunch of them. And I always like to start with, I'll leave this to Kyle, but I do like to start with the history of Social Security and the history of the wage tax itself. Okay. So I'll give it to him, but I do like the very beginning of it. Is Social Security first came out in 1935.
Yep.
Okay? And this is the part that I love. In 1935, you were eligible for Social Security when you were 65. And the life expectancy in 1935 was?
Take a guess.
65. So hey, government comes out with this wonderful plan saying, hey, we're going to give you Social Security, but only after you die.
Yeah. Well, that's a really good spot to kick it off with, because think about the time frame of 1935. What are we on the heels of and still in?
Oh.
The Great Depression.
Correct.
Social Security was never meant to be something that you're able to retire on and live exclusively off of. It was really meant as, and they referred to this in the code as an old age benefit, a federal old age benefit. It's meant for people who lived longer than expected and aren't able to work anymore, the elderly, and especially the disabled. Because at the time, if you get laid off or you get disabled, you have no option to work, no option of income, and this was the federal government's program to tackle that. So as you mentioned, FDR introduced Social Security program in 1935. It took 5 years for the first check to go out. Give me a guess. The whopping amount of the first check.
Oh, I forgot. I used to know this when I did this 3 years ago.
I'll save you because inflation's pretty tough. It's $22.54. $22.54 was the first check.
And it was a female who got it.
It was.
Right.
And Social Security at the time, it really didn't have the same shape. It didn't look the same as today. It was, as you mentioned before, it was very straightforward.
Yeah.
You couldn't take it until you were age 65. There was no disability benefits when it came out. Like if you were disabled, you had to wait until you were 65. So they didn't quite tackle the issue. So it comes out, the first check's in 1940. The program's initiated in 1935. Before the first check goes out, they actually, in 1939, they introduced spousal and child benefits. So before the first check rolled out, they had those two different programs, but until 1956, until disability payments came out.
Wow.
So they really started, it's a very slow process. And even today, what's the third rail of politics? As a politician, what do you not touch? Social Security. It's a really fragile, system to change because it impacts our most fragile people, our elders, our disabled people. You got to take care of them. So the program really took on a lot of different changes. It's not only just about the benefit and when you're able to receive it, but how you pay for the benefit. Because as we all know, if you ever look at your pay stub or your tax return, you have to pay into Social Security.
Correct.
Initially, the payroll contribution that you had to do was 1%.
Right.
Nice, easy 1%. Eventually, it was lifted to 1.5% in the 50s. It eventually got to 5%, and then in 1990, it's got to where it is today at 6.2%. Just for Social Security, Medicare is exclusive of that. So by 1990, you're paying 6.2% of your wages for Social Security for the benefit that you will get later on. And naturally, speaking of the benefit, at age 65, that was your full retirement age benefit for a very long time. It took until 1983 for the full retirement age to be increased to age 66, and at the same time, they also brought about the change for when it would eventually become 67, like it is today, where it shifted into that. So over these many years, it's been 90 almost years that it was introduced into law, and it's taken on a lot of shapes and twists and changes, and over the next decade, we can anticipate a lot more.
Well, and so there's a lot of things that also have, the big driver going on with Social Security right now, independent of the benefits, is the whole program, okay? So they withhold 6.2% of your pay, and the employer also has to pay 6.2%. And they put a cap on it. Fine. Medicare, which is the sister program, really, this isn't designed to talk about Medicare today, but Medicare is the sister program. That's 1.45% paid each by the employee and the employer, but there's no cap. Now, the interesting part about it is both programs, from the perspective of the government, are roughly equal in cost, but combined represent 50% of the federal budget is spent on Social Security. Now, here's the issue that we talk about when it comes to tax planning, which we do all the time. The issue that we have here is the federal government in the most recent budget, last one I remember looking at, was the federal government spends $6.2 trillion a year, brings in $5.2 trillion. Which means that the federal government, in order to have a balanced budget, which we haven't had since the 90s, which even then you argue because of the Social Security actually, but to meet and have a balanced budget, the government needs to either spend less or raise its income, which is in the form of taxes. Now, the interesting part about it is because Social Security represents 50% of the government's cost, to meet the budget, which the government's demonstrated it's incapable of spending less. So they're either going to need to figure out ways to reduce the spending, including Social Security and Medicare, or increase the revenue, which is raising taxes, and or raising the taxable amount or how much you pay into the Social Security program. Now, there are talks about it, and to your point, the third rail. Congress doesn't want to talk about it because they don't want to be the bad guy for changing the program benefits. Because you change the program benefits, you may as well say, I don't want to be reelected.
Yeah. And it kind of goes back into the history of it, because if you look back, there used to be more money coming in based on Social Security taxes than what would go out.
That's correct.
Initially. I mean, think about it. The program comes in, everyone's taking it, no one's collecting it first, right? And it took a long time for the benefit that the government was paying out to exceed the tax that they were receiving. So
which was only a few years ago.
Exactly. But the reason it was only a few years ago as opposed to earlier was because in 1984, the government changed the law and said, let me ask you, viewer, is Social Security taxable, right? So while you're pondering it, it used to not be until 1984 when Reagan signed into law that made Social Security taxable based on your income. Not everyone pays taxes on their Social Security income, but if you have other income, it can be. And that wasn't the case until 1984, and extended the trust fund, if you will, of Social Security by increasing the income. Takes us a little bit into the conversation we're just having of how do they solve it?
Well, that's
2034. Whether or not we get to that right now, it's just that's something that's really on our mind. And when you think about the future of Social Security, it's important to understand the history of it and how we got here.
Right. Well, that's good. Let me expand upon that, because back, I don't remember when this was, but it was 35 people were actually contributing to the system for every one person collecting. Okay.
It's a good ratio.
And then it was not, but I think it's only 2 people contributing to the system for every one person collecting. And I believe it was either 22 or 23. I think it was in 2023. It's hard to believe it's near the end of 24 already. That it was in 2023, to what you just pointed out, the amount of money going into the system became less than what's coming out. And therefore, they're running into a cash flow deficit on Social Security. So some of the talks that they have, and there's a lot of different things about it, it's about 75% funded. They say that once we hit 2033, the amount of money they're bringing in is 80%. Now,
it's 78. And the number
78.
keeps changing.
Right. But anyway, so if they brought in more money, then that would solve the problem. And one of the areas that they could solve the problem is, as of 2024, is at $168,800.
Yes.
Is your maximum income, at which point they stop collecting Social Security from both you and your employer. They said if they just lifted that wage base, they would take it to 96% funded. They're not doing it. Now they're talking about the potential of a donut hole, where they tax you up to 168 and then stop, but once again, using that 400,000 number that they keep throwing out under the current administration, is that once you hit 400, you're back into paying back into Social Security. That will help, but not solve the problem. The other question then becomes, are they going to raise the wage base? Not the wage base, I'm sorry, the 6.2%.
The tax.
The
payroll tax.
The payroll tax. They've been raising the payroll tax since the beginning of time, but they haven't raised it since 94.
In 1990. It was
I'm sorry,
last time they
1990.
raised it. Yep.
So they haven't raised it since 1990. What's to say that they don't raise it? What's to say that they don't lift the cap? They're going to change the Social Security payouts. Do they raise the age for retirement from 67 to 68? Do they make it so that early retirement begins later than 62? There's a lot of ways that this can be addressed. And anytime we're at a seminar and we're talking to people who are experts in the subject material, I always ask, what do you think they're going to do? And I even have another theory. What they're saying is that when they eventually make the changes, they're going to be sweeping. So what they might do is do a sweeping change to Social Security where they increase it from 6.2%. They'll almost certainly increase the wage base from 168, which has been increasing every year.
Yeah, with inflation, yep.
They may very well change the benefits.
Yeah.
And in my opinion, what I think they could do is make Social Security income-based, meaning means-tested. And what do I mean by means-tested? Means-tested says, does Bill Gates need Social Security? No. I mean, he's making millions and millions of dollars a year. So at what point in time do you say you're not eligible to receive Social Security?
Yeah, watch out. If he's watching, he might shut you down.
Yeah, right. I know, exactly. But anyway, so, and then it's like, well, wait a minute. You know, people are going to say, but I've been paying into the system all these years, and all of a sudden they're going to take it away from me, et cetera, et cetera. Hey, you know what? I look at it and say, would the government do that? They're doing it already. Mm-hmm. And what are they doing it with?
On Medicare.
On Medicare. Your Medicare premiums are based upon how much money you make. And if you make above a certain threshold, all of a sudden your Medicare premiums go up. And so I see it as being very possible. And Here's a way to hide it.
All right.
I don't know if I've ever told you this. How they could hide it is rather than saying, all right, instead of me getting my $3,000 a month, if I'm making over a certain threshold, I can continue to get the $3,000 a month. But what they're going to do is bury some form in the tax return that says my tax is $3,000 a month. But at least I got my Social Security. I effectively gave it all back.
That would be a slippery slope because all of a sudden you have people getting income, spending it, and then you're going to owe in taxes. It would be,
Yeah, but you know what though? If you're making $1 million, $2 million, $5 million, $10 million a year,
Yeah.
it gets lost in the mix.
That's very true.
So anyway, we have all kinds of different things. So what we're going to do is we're going to take a break here. And what we'll do is when we come back, we're going to talk a little bit about jumping into the different benefits, et cetera, associated with Social Security. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. I'm your host, Mike Menninger, and I'm here with Kyle Ryan, and we're continuing on with the first part of the Social Security episode. In the first segment, we kind of gave the history of Social Security, the fact that it's kind of running out of money, the history of the taxation of it, et cetera, et cetera. What we're also going to get into deeper into the, not this episode, but deeper into this program is talking about the taxation of Social Security. Now, we talked about the wage tax, that it's 6.2%, but we're later going to talk about, to Kyle's point earlier, is Social Security taxable? Well, it depends on your other income. We're going to get into some stuff there. Now what we want to talk about are the different types of Social Security benefits. And there's a lot of them because everybody thinks of Social Security as, it's my retirement benefit, okay? But there's a whole lot more to it.
Yep.
You've got the retirement benefit, you got a spousal benefit, you got the survivor benefit, okay? And the survivor benefit could also be for the spouse or the children or both.
Yep.
You've got the disability benefit, and you also have a child's benefit when the parent is alive. Okay? You don't see that too often because the child has to be under the age of 18 in order to receive a benefit from the parent who's collecting, which means the earliest a parent could be collecting is at age 62, arguably 60 if they're a surviving spouse. That means they had the kid when they were 42 or 44 at least. You don't see that often.
No.
Okay?
And it is dependent, so it could be an adoption, anything like that. But yes, any child under 18.
Correct. Correct. And I actually did have a client who we did that with.
Yeah.
So I always beat him up.
Good planning.
Like, you're killing me. You're killing me. All right. But anyway, so again, those are the main benefits. The retirement benefit we're going to spend probably the most amount of time on is it's first eligible at age 62. Then your full retirement age, which is today for anybody born 1960 or later, is age 67. If you're born between 1954 and 1959, it's between age 66 and 67, like 66 and 2, 66 and 4, 66 and 6, 66 and 8. Okay, those are the different full retirement ages, which we'll also talk about the relevance of full retirement age. Then the spousal benefit, we're going to talk more about that, the survivor benefit, the disability benefit, and the children's benefit.
Yep.
So let's talk about the retirement benefit. The retirement benefit is defined really as everything is based upon what's referred to as the PIA,
Yeah, it's the most
the
common.
primary insurance amount.
It's the most common one that comes out. You know, once they used to send it out, what, when you reached age 50, you'd start getting.
No, you always got it.
Okay, so now it's what, age 50? You
You
start
used to
getting
get your statement 3 months before your birthday.
Yeah.
You know, there came a point in time when they were sending Social Security statements, there's a cost to that they stopped doing it. And this is probably about 10 years ago. And then what they did is once you turn 60.
Yep.
3 months before your birthday, you begin to get a statement. And I remember the vivid green statements. In the upper right-hand corner, which by the way, they changed about 2 or 3 years ago. In the upper right-hand corner, you had a number, 3,500, whatever. That was what your full retirement age benefit was, which is your primary insurance amount.
And whenever you did receive those statements, that refers to your retirement benefit. Everything else, every other benefit, the spousal, the survivor, a child's benefit, disability, it's all listed on your benefit page as well. It just isn't particularly about you. The main information on the retirement benefit, your retirement benefit, is all on that statement. It really contains all of it. So to kind of get into how the benefit is calculated, go ahead.
Right. So the benefit is calculated is what they do is they take the average of your 35 highest years of income, and they take that average and then divide it by 35 and then divide it by 12, which is a monthly benefit. And they slap it onto a table, which I'm not going to go into the details of it, but that determines your benefit amount. Now, what's interesting about it is it's not a straight line. And what I mean by that is if my average salary for 30 years was $80,000, my benefit is not twice as much as somebody whose average was $40,000. In fact, their benefit is probably 2/3 to 3/4 of mine.
Yes.
Because what happens is they take the average salary, and let's say I was 84,000, which is 7. They take the first 7,000 a month. The first 1,000 is like 90%. The next 5,000 is 32%, and then above that is 15%. And so, believe it or not, there comes planning strategies that you can do with husband and wife,
Absolutely.
which I've got another one. Got an example for one of those. But so the primary insurance amount is defined as your full retirement age benefit. But is it fair that in 1980 I made 30 grand? Whereas today, 30 grand is
30 grand in the 80s is not the same as 30 grand today.
That's correct. So if you were to ever dig into it, what happens is that, and there are tables out there that show what the full benefit, the
calculation of it.
the wage base.
Okay, yeah,
Okay. And there was also in there that, like, you go back to 1980 and you take a look at what it is today. Today, the wage base is almost, actually prior to 1980, because we had those big inflation years. So what was it, like 1976? You take a look at 1976 and today, and it's almost 10 times as high today on the wage-based benefit.
Yep.
So what they actually do is if I made 10 grand in 1976, they multiply it by 10 to be the equivalent of 100,000 in today. So what they're doing is they're taking and applying all of the inflation numbers to those monies that we made decades ago to put it on a more even plane, and then they take the average.
It's really interesting to look at. If you've never really kind of looked into your Social Security statement, go look at it and go look at your prior year's earning history. It'll just be a little nostalgia for you. But also what they do, it's because I just had this week happen. I had a client who was looking at it, and they take, in your early years, they lump sum together a decade.
10 years.
And she's looking at it, she's like, I think there's an issue here. They're going to reduce my benefit because they think I made 300 grand that decade, or that year, because they were lump summing it all together. So it's just an interesting thing to look at, just to kind of look at the history of your earnings.
Well, it is cool, and unfortunately, I'm saddened by the fact that they changed it. Okay, it used to be they showed all of your earnings history.
Now they lump sum.
Right, and that was again
Less
about
than
3 or 4 years ago.
Yep.
That's because it took a couple pages to do it. But so what? You got the data.
Yep.
Okay, and if you're looking at it online, why are you doing and reducing it?
And if you are looking at it online, another thing to be aware of is that if you're looking at it ahead of your full retirement age, so say you're 60 and you're looking at your Social Security benefit, the assumption of your benefit is that until you reach your full retirement age, you'll make as much as you are today. So the benefit that you see on your statement is as if you were working till 67. If you want to adjust the benefit, you have to request it online or by calling.
Correct. And so what you do is you look at your statement, and it shows you what your income was the prior year. Okay, and it assumes you make that every year between now and 67. To elaborate on Kyle's point, if you're 60 and you made $120,000 the prior year, it assumes you're making 120 every year between now and age 67. And if you think about the average of 35 years, that can make a big difference.
Absolutely.
Okay, so just be cognizant of that, because a lot of people say, well, gee, how come it's not what they said it was when they begin to take it? And that's because of how it's calculated. But it's also doesn't change as much as you'd think. It depends on your history. I mean, if you've been making good money all those years, then a few big years at the end won't make that much of a difference.
No.
But if you are, and we see it a lot, stay-at-home moms raising their children for 15, 20 years, all of a sudden you have a bunch of zeros in there. You throw a decent number in there, and I'll tell you what, it makes a big difference for them.
And it goes back to what you were saying before about how they calculate their benefit. They really weight the first amount of income.
Right. That's correct. That's correct. So understanding that primary insurance amount. Now, that again is what it is for your full retirement age. And then if you're taking it early, then there's a reduction. You're taking it late, then there's an increase. If you're disabled, it's based on the primary insurance amount. If you have a spouse, it's based on your primary insurance amount. If you die, your survivor gets based on your primary insurance amount, and your children get based on your primary insurance amount.
But don't forget about the whopping death benefit.
Oh, yeah.
It's $255.
Don't spend it all at once.
Yeah, not inflation adjusted.
Yeah, and you know what? That's actually kind of interesting about not inflation adjusted.
Yeah.
They never moved the $255.
Yep.
And they also never moved the numbers for the taxation of Social Security. They've been there.
And we're going to
40
cover
years.
that. Yeah, we're going to cover that in the next episode, what those numbers look like. But
Right.
even when they first came out, the death benefit, I mean, unfortunately, most of us know what a funeral costs today, and it is not $255.
Yeah, it's a little bit more
But
than
that used to be able to
$255.
stretch you a little bit further when it first came out.
So what we're going to do is we're going to end the episode here, okay? What we're going to do is we're going to have another episode we're going to pick up and talk about how the retirement benefits are done as far as your full retirement age, taking it early, taking it late, et cetera, et cetera. So thank you for joining us. Kyle, thanks. And we're going to get ready to do the next episode on this. So I hope you learned something today, and I look forward to seeing you on our next episode. Thank you for joining us, and have a wonderful day.